Okay, let's get started. Welcome everyone to the final WEFI seminar of 2020. We have one more event next week, the lecture series, which you should get an email about, but this is our last seminar of 2020. We're happy to have Avri Ravid here to present some work on innovation under ambiguity and risk. Just a quick reminder on the format. I think we have a lot of repeats here, but just a quick reminder. We've got 40 minutes for the presentation. If you have questions, just use the chat. Clarifying questions will likely be answered by, we have two co-authors here, so that's great. Deeper questions, we're going to allow the co-authors every 10 to 15 minutes, excuse me, to let Avri know whether it is a big enough question to pause and answer. But otherwise, we'll have a Q&A at the end of a 15-minute discussion after the 40-minute talk. And after that, again, the Q&A. So with that, I'm going to hand it off to our presenter. Thank you so much for being here.
Thank you very much for inviting me. And since this is the last talk of 2020, I would also like to thank the organizers for putting this together. This has been, a really great event, and one of the only positives of the Corona period, that we've been able to put together this group and come together for seminars. And I'm grateful for them and thank you for putting our paper on the program. So I'm going to start sharing my screen here. Oops, this went a little far. This is a joint paper with Yehuda, Izhakian, and with Gabriela Coiculescu. We're also on this call. So let me first summarize the whole thing. And it's pretty straightforward on the face of it. Then it becomes a big, complicated issue to put it together. So the philosophical question is, what is risk exactly? And people have been grappling with this for a long time. In finance, we usually talk about variance. Variance means we know the outcomes and we see how spread they are. But very often when you think about real decisions, and I kind of cite at the bottom where you can't see a study that did a survey on that, people just are not sure how likely it is that things will be bad or things will be good. And this is what is ambiguity. This is what ambiguity is all about. So this concept is due to my co-author, Yehuda. And his, several published papers and other working papers on this. And what we're doing here, we're taking this concept and applying it to super simple, and I mean really simple. I mean, usually people say simple model, and then there are 20, me too, and then there are 20 pages of equations. But this is a really kind of toy model of real options. And we show that, as we all know, we didn't need this model, that when risk, meaning variance, goes up, firms will, the value of the option will increase. And importantly for us, when ambiguity goes up, the value of the option declines. And when we take this to the data by looking at investment in innovation as a real option. So we think this is true for any investment, but we think that investment in innovation would be where there would be bite empirically, because that's what we do. We create real options when we invest in R&D, when we patent something, so that's a bit later in the game. So we take this and we merge this. There are several databases involved. Maybe I'll talk a minute or two about what we have. And we take all these databases, put it together in and apply it to patents and R&D, which this group is very familiar with, and try to see whether it is indeed true that as risk goes up, the investment in R&D and patenting go up, and when ambiguity goes up, investment goes down. We find support for our predictions on ambiguity. With risk, it's more nuanced, and that's basically the whole paper. So it's very simple and straightforward, but there's a lot of stuff in putting this together, and I'll try to get to some of this, even though probably not all of this, and you're very welcome to read the paper as we go through the presentation. So literature review, I will skip most of this, but it goes into two literatures. One is what are the determinants in innovation? And I mentioned here a whole host of papers, several people who are part of this group and others. Uh, for example, I'm just picking one paper which is actually in the next page by Shai Bernstein. When employees, the question was, when employees have less certainty, do they innovate more? Economic insecurity and employee innovation. Um, and then there's Agion, which was in the previous page, on institutional ownership, and there are tons and tons of papers which this comes into. So the big question, what prompts innovation? So we come into this literature. The other literature, oops, sorry, the other literature is decision science and ambiguity. So there's a whole literature starting with on ambiguity. Well, we could start with Knight, as you'll see in the next slide, but we could talk about Gilboa and Schmeidler and others that try to talk about the types of uncertainty that are there and that are priced in the market. And my co-author, as I said, had several papers now that use these things and try to see when ambiguity matters empirically. And then we use a lot of methodologies in papers by people in this group and others to make all these many decisions, as many of you know, come when you deal with patent data, R&D, and other types of data that we have there. And we also had to do some microstructure. So you told me just a few minutes ago not to say it's microstructure because it isn't really a microstructure paper, but we had to do microstructure type issues to deal with them as well when we computed the risk and the ambiguity measures. So the roadmap is we start with decision theory. I'm going to show you what ambiguity is and then what we expect to find in the real options model. Then we calculate the ambiguity measure, and then we add corporate finance, all the firm characteristics, all the control variables we all know and love. And then we throw all this mix into the innovation literature. So we have all the issues that you're all familiar with patents, R&D, et cetera, that we kind of use. And then we see if we can answer a question. Overall, what we have tried to do is what we are doing is trying to find something that will be not controversial. We'll see what our discussant thinks, but something that's really non-controversial, do what everybody else is doing in terms of the innovation, R&D, et cetera, and try to see how our new additional contribution, the ambiguity measure, how does it change things? Okay, so what is ambiguity? And what is the difference between ambiguity and risk? So as I said, and this goes back, as I said, to Frank Knight in 1921, everybody knows what Knightian uncertainty is. We don't have a lot of time here, so I'm going to do a few examples to show you what is our notion of ambiguity, which we think is actually a very good notion. I mean, if we had plenty of time, we could discuss why we think this is important. I'll just say to those of you who are into this, that this notion of ambiguity, which is essentially trying to capture whether people, a situation where people do not know whether things are likely to improve or get worse. So this notion that we have is basically better because it is not outcome dependent and it does not depend on preferences. So that's for those of you who are into the theory of this. And if you really want to, we could possibly discuss this further. Yud will be happy to answer questions on this. But again, the issue is risk is when you have known probabilities. Ambiguity is when the probabilities are not known. And we're trying to capture this notion of distribution over distributions. So that's the notion of ambiguity. You'll see in a second. So let's think of a coin toss. Promise you it would be really simple. So a coin toss, 50% 100, 50% 0. So I calculated the variance, and hopefully I can do middle school, or I guess elementary school math. So it's 2,500. Now let's think of the same thing. Now we increase the outcome to 1,000. As you see, as we know, the variance goes up dramatically. So that's variance. It's outcome dependent. Now let's look at an ambiguous situation. So an ambiguous situation is the same thing, but we don't know whether whether 100 is what is exactly the probability of 100 and 0. So there is 50% chance of the probability are 30/70, and there's 50% chance of the probability are 30/70. So now what we can do is we can calculate the expected probability, which in this very simple case is 50 for both outcomes, 50% for both outcomes, and the variance of the probability. And in fact, the ambiguity measure is the expected value weighted variance. So that's essentially the probability measure. But just to show you what's the difference between ambiguity and risk, let me do the following experiment. So remember, it's 0, 100, 0, 100. I'm now changing it to 0, 1,000, 0, 1,000. The ambiguity measure, the expected probabilities and variance of probability remains exactly the same. So that's the notion we're trying to capture. The notion we're trying to capture is the uncertainty in the probabilities as opposed to the outcomes, which are captured in variance of risk. So hopefully that makes a little bit of sense. This is kind of the basic notion. And I will I'll just say briefly what the framework does. So the framework that you developed actually has a two-stage procedure. So in the first procedure, the decision maker looks at the ambiguous, at the unknown probabilities, forms certainty equivalent. Once you form certainty equivalence of probabilities, you are now in a situation which we are all familiar with, where we have probabilities and outcomes, and then we can compute utility. So I don't have a dog, so that's not me. The ambiguity averse decision maker, and that's important here, outweighs the probability of bad outcomes and underweight the probability of good outcomes. That's what this framework tells us. So now we come to real options, and after I do that, I'll stop and see if there are any questions. So we use the framework, and I'm just showing you the formula. I'm not going to talk about it, but this is I'm going to again show you a really, really simple example. So we have a formula. We can use the framework to calculate the value of real option under ambiguity, and we use it in theoretical discussion of this investment. But let me show you how real options look like in an ambiguity framework. So first of all, let's consider real options in the usual without ambiguity, which is risk. So again, very super simple. You have to invest $100 in a project, and the outcome could be 0 or 80 or 120. So the value of the real option will be half of 120 minus 100, which is 10. This is risk neutral. You can throw Black and Scholes at it or whatever you want, and you'll get the similar intuition. I don't really need to teach anybody on this call how to do options. If we increase the spread, we increase the value of the real option if we just consider risk. So let's now come to the first conclusion that we're going to test, and that is increased risk, value of the option goes up, there'll be more investment in innovation. Now, with ambiguity, we'll see that things are a little bit different. So we go to the same thing, but we have now uncertain probabilities. Unknown probabilities could be either 40-60 or 60-40. So I don't think I want to get into all the details, but we can compute the ambiguity measure, and we can compute the value of the option under ambiguity. So I'll just turn your attention to the line in red at the bottom here. And what you see is, and we can talk about it, we get to the value of the option. So the value of the option, there are two numbers I want to show you, and I'm circling them right now. So one is the number 2. This is the ambiguity aversion measure. And 0.01 is the variance, variance of probabilities. So those two measures, as you can see, come in negative. So as the variance goes up of probabilities, and as the ambiguity aversion goes up, then the value of the option goes down. Now, of course, we don't know what is the ambiguity aversion, the same thing as we can't measure risk aversion in the data. But in this example, the value of the option goes down from 10 to 9.8. And here it goes once I increase. So now I increased the spread 70-30, 30-70. I increase the spread, then the value of the option goes down to 9.2. And you can, if we had time, I would follow up on this. So again, higher ambiguity, low option value. So I now want to get to the hypothesis. And before that, if there are any questions or any comments, I didn't follow the chat. So if there's anything so far.
Looks like you're very clear. No questions yet.
Okay, thank you, because I haven't just explained the framework. So that's good. Okay. So now, so what are the hypotheses out of this? So first about risk. So first hypothesis is obvious, and there's some work that has been done about it in the context of investment. As risk goes up, then investment innovation would go up. The opposite hypothesis, this comes back from to Nick Bloom's work, which I'm citing here, and I cite another paper of his. But it also goes back to work by Andrew Abel and others, is that if the risk goes up, it could be that actually innovation investment will go down. And the reasons could be adjustment costs, could be an increase in the value of weighting, of the real option of weighting. And there are several papers on this issue that do come to the opposite conclusion. So we test this one against the other. In terms of ambiguity, we don't have an opposite hypothesis. Our model shows that as you have more ambiguity, then the value of the option will go down, so investments will go down. So that's these are the very simple hypotheses that we test. So the way we do it is, again, like I said earlier, what we're trying to do is do what everybody else did. So there's no kind of people who will feel we play games or try to do the data differently. We use every control variable we have found, and if there are others, you can let us know. We're happy to add them. I'm saying we're happy to add them, but as you know, these things take a lot of work, but we'll be happy to add them. So very simply, we run R&D on the left-hand side against ambiguity and risk on the right-hand side, plus control variables, fixed effects, and everything else. And then we run count models. In other words, Poisson and negative binomial on patents and citations on the left-hand side, and then ambiguity, risk, and a lot of controls on the right-hand side. So moving on to the data. So we have CompuStat, CRISP. We also use Patent View, IBIS, and Thomson Reuters 13F for some of the variables. We use TAC, that's where the microstructure comes in, TAC for the computations of ambiguity and risk. And let me just talk very briefly about how we compute ambiguity, because that's kind of the new thing in this paper relative to everything you might have seen before. So it's actually the basic building block is 5-minute return on stock. So we take the stock of the firm in question, and then we look at 5-minute returns, and then create histograms between -40 and +40, drop extreme observation. There are a lot of decisions here to be made, but in principle, think of it as histograms of all the returns, 162 histograms, 5 minutes at a time. So we get histograms like that for every trading day and all days of the month. Now, the assumption is that every histogram is equally likely, and there's a discussion if you want why we do. So, sorry, I have to say that we're assuming that the probability of all the returns is normal. That's how we get the histograms. And then we take these histograms and we assume they're equally likely over the month. And then we calculate what we need for ambiguity, which is the expected value and the variance of these probabilities. And we also unlever returns, doesn't matter. We did it both ways, seems not to make a difference. And we have an explanation for that. So that's the ambiguity measure. And, you know, that's what kind of looks like. You know, these are the bins. You see that for the day in blue, you have these returns here. For the day in green, there's nothing in this bin, but there's something in this bin. Then the day in red, there's nothing in the first two, and there's something here. And so all of this is taken together, and every bin is assumed to be equally likely over the month. So that's a lot of work, which you did indeed for computing this measure, just to show you that it empirically matters. And that's kind of an interesting thing in itself, which we're not going to discuss in great detail. This is if you do the same for the market index, and that's monthly data. You can see that ambiguity moves a lot. And interestingly, if you think about where we are today, ambiguity was very high, as you can see, at the end of 2019, beginning of 2020, just before the crisis started. And then it went down when the crisis happened. So I think that gives you a little bit of a sense what exactly this measures. So, okay, so we have a lot of firm quarter. We started in 93. There are data limitations on the patent data. There are data limitation. We use Kogan patent data. There are data limitations in the patent on TAC, and we have to cut everything. So we have 3 types of samples that we use, and each sample includes firms where at least 1/4 was positive, something happened. This is to avoid all the zeros that you get in this literature. So we have the R&D sample, 66,000. They're more or less the same. Patent sample, 63,000. Citation sample, 62,000 firm quarters, about 2,000 firms. They overlap, but not completely. Okay, control variables. We have sales, Tobin's Q, leverage, firm age, analyst forecast dispersion, institutional ownership, and several fixed effects. So we could talk about for example, for the patents, we use the Blondel fixed effects, which have been used in other papers. So, all right. So what I want to show you now is very simply that basically our predictions for ambiguity seem to work in the data. So what you're looking at is the R&D samples. We're looking at the firms that have at least 1/4 of R&D over our sample. And we run ambiguity and risk and a whole host of control variables. You see some of them. I cut them here. I didn't show you the whole thing because the table would look way too messy. But you can see that ambiguity essentially is negative. And we're looking here at the first row, negative and significant, 1/4 ahead, 1 year ahead. And it's most significant for high-tech firms. We classify firms into high-tech versus non-high-tech by industry classifications, as has been done before. As I said, this is not a new way to classify. And we see that the high-tech firms' ambiguity is negative and significant in the correlation here. At risk, as expected again by the real options framework, it's positive and significant. So for R&D, And, we did a lot of robustness and we ran it differently. We took high-tech firms and cut them by age. So age doesn't seem to matter. It's not the firm is older or bigger. It's essentially the high-tech versus non-high-tech. And you still see that ambiguity. Now I'm just showing you ambiguity and risk. So ambiguity and risk are basically, negative, as ambiguity is negative, risk is positive, as we would expect. So it seems like this investment is indeed follows the logic of the real options model with added ambiguity that I've presented to you before. And we added institutional holding. There's this paper in institutional holding. We got some results in institutional holding. It holds for recession, non-recession years. You see every time presented, somebody adds some control variables, we add them. It doesn't seem to take away anything from the results. It seems to, matter differently for different control variables. But again, ambiguity is always negative. However, we run it for R&D, and risk is always positive. So this is, and then we ran it on patent data. So as I said, so all of you, most of you have been working on patents, so I don't have to convince you that patent could be viewed as an option. We're citing here the medical literature where people basically patent every molecule as an option for the future. But here, clearly, you could argue that it's further down the process than R&D. And what we find when we do the same exercise, so it's the same exercise, except that we have a count model, Poisson or negative binomial with patents on the left-hand side. And we see that their ambiguity is still negative, however we run it. Risk is a little trickier. And when it is negative, so for example, in this cut, which is the top tercile, the firms that patent most, then we see that risk is significant and negative. So in fact, for patents, when we run it, we see that when risk is negative, when risk is significant, it is actually negative. And that we interpret as support for ideas such as Nick Bloom, going back to Abel, as I presented before. And that is also consistent. So however we run it, we seem to get these results. It's not always as significant, as you can see, but when it is significant, it is negative. So this is the marginal effects. The marginal effects, just to say, look at the number here. I should have highlighted here when it says marginal effect. This is the number of patents. So the number of patents is actually reasonably significant. We all know the patent data. There aren't that many patents. So, and this is 1 quarter to 3 years ahead. So the ambiguity would make a difference between 1 and 8 patents. That's a lot. If we remember where the median, and in particular where the median looks, what the median looks like, the mean obviously is less significant for patent, is less important for patents, but it's a significant number, and the same thing for risk. So we're kind of convinced that this is there for patents as well. This is also for high-tech firms, same kind of thing. Ambiguity is negative, and risk is negative as well. Again, we have the Poisson and the negative binomial. So for patenting, we see that it decreases both with ambiguity as predicted and with risk as predicted in the Bloom in the previous literature. And the interesting thing is results are, which is, I think, supports what we do. The results are strongest for patent intensive high-tech firms. It's not driven by size. It's not that when you have larger firms, this is what happens. It's for firms that actually patent and are high-tech firms. The results for citations. So we use citations, as we all know, citations are used to proxy for quality of the patents. And whoops, this is citation, sorry. That's the table on citations. Sorry that I skipped it before. So citations, the results are the same. They're a little bit weaker. I'm showing you for the high-tech firms, the results are pretty significant for both risk and ambiguity. And but in some other runs, they're not as significant especially for risk. So this is essentially the conclusion. The way we see it is that there are two components of uncertainty, and perhaps more, but there are two components of uncertainty that we capture here that should matter for innovation. We have a real option model that shows you how the option increases with risk and decreases with ambiguity. And the empirical estimation is based on the ambiguity measure that we have discussed, and also with the comment that we had in the middle. And we do find that ambiguity decreases R&D and patents and citations, particular for the firms where you would think that it is. And, you know, I don't know what the discussant is going to say, but we can discuss a little more on that issue. The effect for risk is more nuanced. We find that risk indeed decreases R&D, increases R&D, but it decreases patents. And we interpret it as supporting the ideas of Nick Bloom and others. And if you're wondering what is the photo here, it's out of my deck where I've, you know, the only place I've been out a lot over the last few months. So this is what it looks like in sunset. And thank you very much. I'm looking forward to the discussion.
Wonderful. Thanks so much. Our discussant is Stephen Terry from BU. You have 15 minutes.
Perfect. I'll set my timer off so I can track that. So let me make sure we can all see my screen. Slides in front of everyone, voice coming through, thumbs up?
Yes.
Perfect. Done this Zoom teaching enough that you always got to do that last double check. So thanks so much to the organizers for running this seminar series and for inviting me to discuss this paper. It's not only useful as a service to the profession to have this type of series in place, I also very much enjoyed the opportunity to spend time with this super cool paper. I learned a lot and enjoyed spending time with it. So I'm Stephen Terry from BU. I'm a macro person. Let's start, before I start talking about this paper in too much detail, with a quick recap of something that you saw skillfully overviewed already, which is a quick intro into what ambiguity and risk mean in this uncertainty context. So we're going to think in this paper about two types of uncertainty. And in the sage words of Donald Rumsfeld in advance of the Iraq War, there are known unknowns and there are unknown unknowns. One of those is risk, one of those is ambiguity. Okay. So let's do this with some quick examples. So risk is uncertainty over outcomes conditional upon known probabilities. So let's do a quick lottery. If I offer you a lottery that says with 40% probability, you get nothing, with 60% probability, you get $1 million, I can talk about variance in those outcomes or uncertainty as risk. We have theories of risk aversion that link that type of risk to behavior. Okay. We can also talk about ambiguity, and that's uncertainty not just over outcomes, but about the probabilities themselves. So here, let's think about that same lottery. So I could say, maybe things are as I described. With 40% probability, you get 0. With 60% probability, you get $1 million. Or maybe it could be 60-40. Who knows? Okay. There may be uncertainty over the probabilities themselves. We'll call that ambiguity. And just like for risk aversion, theories can link risk to behavior. There are theories of ambiguity aversion that link that type of uncertainty over probabilities or ambiguity to behavior as well. So I think it's fair to say, not about this paper, which I think actually makes progress in both dimensions, but in the literature and in both finance and macro, theoretically and empirically, there's a lot more attention paid to risk. Okay, ambiguity is kind of understudied relative to risk. And I think this nice paper makes progress in both dimensions. It relies upon progress theoretically and kind of thinks about it in a very natural empirical context. And I really appreciated that about this paper. So I want to talk a little bit about both of those sides before I make any comments, just to continue summarizing. On the theoretical side, I'm throwing a lot of stuff at you here, but I just want to quickly recap the output of what is kind of a longstanding and distinct kind of channel of theoretical work that one of the co-authors on this paper has done to understand expected utility with uncertainty and probabilities, EEUP, which is a framework for thinking about decision theory in an ambiguity structure. Okay. So what's going to happen? Well, when we have ambiguity, we're going to think about agents that are making decisions about outcomes X, and they have probabilities phi of X over those different outcomes. But now the probabilities are themselves random variables, because there's like a distribution of probabilities. So outcomes are random, but so are the probabilities themselves. And so the way that this kind of theory tells us to think about ambiguity aversion is a two-step process. First, ambiguity averse agents collapse uncertainty across probabilities phi of x into a single perceived probability q of x for any outcome. How does this work? Well, naturally, in this kind of theory, the perceived probability depends upon the average probability across possible distributions, the expected value of phi of x. But in the same way that risk aversion can map lotteries to certainty equivalent outcomes, they're going to have ambiguity aversion and some curvature over probabilities and some function upsilon with some derivatives here that collapses variance across different probabilities, the variance of phi of x, into the perceived probability of q of x in a way that can either be positive or negative, depending on where you are in some distribution. Okay? So just like risk aversion gives us curvature over outcomes, this is going to give us curvature over uncertainty over probabilities that is useful in mapping some distribution of probabilities into a single perceived structure. Once that perceived structure probability q of x for some outcome x is in place, we're just back to standard expected utility. The second expression in this slide tells us the objective of a decision maker in this context. Okay. The way it works, and the reason there's a plus and minus here, is there's some reference dependence in the background. So, given some amount of curvature, which shows up and maps variance and probabilities to these certainty equivalent style perceived probabilities, you're going to end up with good states, x's probabilities deflated, and bad states, x's probabilities inflated. Okay, in a degree that depends upon their curvature. And one of the things I really like about this structure is that it's much more flexible than a very old way of thinking about decision-making subject to ambiguity that has very stark max-min objectives, where basically you have some ambiguity or variance in probabilities, and you're just going to assume worst cases and make decisions under that structure. That's a very powerful and almost like weaponized, because it's so powerful in this area, theory of ambiguity that we're generalizing with this theory and kind of treating more flexibly and potentially more quantitatively reasonable. When you have some notion of distribution of probabilities that is collapsed subject to some preference style curvature in this upsilon function into perceived probabilities, we can talk not only about those certainty equivalent style perceived probabilities Q, but we can also talk, without thinking about people's preferences over ambiguity, about the amount of ambiguity. And so they're going to define this, something that I had to look up, an inverted ohm symbol. Inverted ohm squared is ambiguity. They're going to define this object, which is a measure, a preference independent measure of the degree of ambiguity in any structure. That just, for all of the outcomes at work here, takes some average probability weighted variance of probabilities across distributions. How much ambiguity is there? That's the same thing as asking how much variance in probabilities there is across the different probabilities in a mean weighted fashion. So I've got a flexible theory of ambiguity aversion in hand, which I really like. I think that's a nice contribution that this paper is building on. It's very flexible. Empirically, in addition to building on that strong theoretical foundation, this cool paper chooses what I want to emphasize is a very natural empirical context, risky innovation or R&D. Okay? By introspection, or kind of probably research of a lot of people in this room, we know that not all R&D investments pay off with certainty. Okay, there appears to be risk involved in the innovation process. And when we think about how the traditional literature on uncertainty treats that, there are these two ways of thinking about uncertainty. One is risk and one is ambiguity. In the risk context, it turns out to be the case that the predictions for volatility or risk or uncertainty on R&D are pretty ambiguous. A classic literature treats R&D as something that involves convex payoffs, in which case risk is great, Jensen's inequality is wonderful. Or, okay, literature on kind of uncertainty, mainly in macro, thinks about things like adjustment costs or financial frictions that could cause risk to be deleterious for R&D investments. So when we're thinking just about risk, we don't exactly know what to predict for R&D. By contrast, if we think about managers that are making decisions about innovation and R&D subject to ambiguity aversion, ambiguity, as was highlighted in the presentation, kind of robustly allows us to predict lower innovation in any context where managers find it hard to form a single precise distribution of outcomes. And this makes a lot of sense to me. I mean, if we're thinking about investing in a coronavirus vaccine from the beginning of this year, is it clear that we can even assign probabilities to that? It's not clear to me. Okay? And that's the kind of logic here, is that ambiguity might affect willingness to invest or innovate. What does the paper do? Well, we've just seen it. It combines CompuStat and patent microdata and rich high-frequency kind of returns at firms to create proxies for risk and ambiguity. And then it runs regressions of R&D and patenting on these risk and ambiguity measures with various other controls. And kind of consistent with, or quite consistent with the theoretical motivation, they're going to find mixed results for risk and kind of robustly negative associations between proxies for ambiguity and R&D. Okay? So it kind of lines up quite nicely with the predictions of the theory here. All right. So now that I've spent some time summarizing things, let's get to kind of my views on the paper. So the first thing, it's really easy to summarize my view on the paper. This is a really cool, nice paper. I like it, okay? It's well motivated. The clean kind of underlying flexible theory of ambiguity aversion I find to be quite attractive relative to a max-min structure. And I also find the context empirically, the study of R&D and innovation, to be quite natural here. The kind of striking findings about heterogeneity and associations across risk and ambiguity both line up with theory and kind of make sense given their motivation. So I think there's really a lot to like in this project. And so I enjoyed spending time with it. There are 4 things I want to know more about. And I think given both the theoretical agenda by these co-authors and their empirical prowess, they're well placed to kind of provide more light in each of these directions. So the first thing I want to know more about is a little bit about the assumptions underlying the ambiguity proxy. I also want to know a little bit about the potential impact of time-varying distributions of news on this ambiguity measure. I want to make a suggestion, which is that there are kind of some cool surveys out there that I think might be useful for constructing ambiguity proxies of this sort. I want to ask a couple of questions about endogeneity. Okay, so let's dive into a discussion of and a request basically for just a little bit more context on some of the underlying theoretical assumptions which justify the ambiguity proxy. So as was already described to us quite skillfully, they're going to look at equity returns for a given firm, and they're going to look at 5-minute high-frequency equity returns. In any day within a month, they're going to put all of those into a histogram across a bunch of bins. Then they're going to, across trading days in a month, take the average probability in a bin and the variance of probabilities in a bin across days, and they're going to create measures then of the mean of a given bin's probability and its variance. And their proxy for ambiguity, motivated quite tightly by the theoretical structure, and it's just this upside down ohm squared thing, is going to be proportional to just a sum across the bins of the probability of each bin on average and the variance across days of the probability in that bin. So a question I have in this context is, why we would necessarily ex ante want to think about the realization of 5-minute returns in different days as representing different priors considered by some sort of ambiguity averse decision maker. Okay? That might be a reasonable assumption, and certainly under that assumption, this is a natural proxy, but I want to know a little bit more about why I should think of every trading day as a different prior or a different possible distribution of probabilities. In particular, I would want to know why that assumption is well motivated relative to an alternative where there is just news that arrives within the month and shifts the distribution of trading in, maybe say, later days relative to earlier days. Okay, that type of shift could lead to variance in bin probabilities just because of news, even in the absence of ambiguity shifts. Okay, so I want to follow up a little bit more on that. Let's think more about distributional shifts and concretely consider bad news, okay, which arrives for a firm 2 weeks into a month and is known to investors. In the macro finance literature on uncertainty, we commonly see 3 things that move together. First moments, expectations declining. That's what bad news is. Second moments increasing and skewness declining. That shows up for households, firms, real outcomes, financial outcomes, forecast errors. So let's think about combinations of different distributional shifts, different news that could arrive later in a month. If we just have means that decline, by my reading, this ambiguity process is going to increase while the risk proxy is not going to change. Risk here is just realized vol. If expectations decline and variances increase, both ambiguity and risk measures increase. If just third moments move with the first moments, ambiguity changes, but risk doesn't. And if all of them move, both of the measures change. So that's kind of my quick predictions for how distributional shifts will map into these proxies. So there's some real pros of their measure of ambiguity, this upside down ohm hat. On the one hand, it robustly picks up distributional shifts, many more distributional shifts than the risk proxy would. On the other hand, it does, by my reading, late arriving news would create distributional shifts that would show up in this method in addition to ambiguity. And so I want to know a little bit more about kind of trying to separate those two in this proxy. The third thing I want to highlight, and this I think is potentially useful as kind of a future source of empirical variation for the authors, is this cool survey that's produced by the Atlanta Fed called the Survey of Business Uncertainty. It's representative across firms, both private and public firms. You can get the microdata much more easily than you can for the census. And they ask managers at the monthly frequency to predict a distribution of outcomes where managers separately choose outcomes in different bins that could occur for their sales growth, for example, or other outcomes, and probabilities across those bins. So you're kind of eliciting both outcome levels and probabilities in a way that very naturally would map separately to notions of ambiguity that are purely probability-based and probability plus outcome-based risk measures. So I think this survey data on uncertainty might be a useful tool going forward, in addition to the already cool asset price proxy for ambiguity that they have. Okay, the final comment I want to make here is just to ask some questions about kind of the nature of causality here. A lot of the specifications boil down to some outcome X, whether that's R&D or patenting, at some firm I in period T+1, relating that to proxies for risk or ambiguity on the right-hand side. So kind of throughout the paper, there's a description that uses the word effect for this type of relationship. But if R&D and innovation are risky, and changes in R&D induce changes in the distribution of outcomes, like patenting, then you could easily have a world where pre-announced changes in R&D projects could impact distributions that are perceived by investors and show up in these ambiguity and risk measures. And that's not purely alleviated by the difference in timing in these regressions. Okay, so I would probably switch to kind of purely correlational language here. The long list of controls really helps in this context. An alternative approach is to look for some sort of IV or external variation in ambiguity and risk proxies. In the purely risk-based uncertainty literature in corporate finance, people like Stein and Stone have done this and found results that are very consistent with this paper's results as well. Okay, so I just want to summarize here by saying this is a really cool paper, both theoretically and empirically. It's well motivated, and I really learned a lot from it. And I think these authors are incredibly well placed, both theoretically and empirically, to kind of shed light on each of the questions or comments I had. Thanks very much.
Great, thanks, Stephen. Avri, do you want to take some time to respond? We got plenty of time left. So
yeah, I could respond. Are there any other questions? I haven't looked at the chat.
I don't know. I don't see any.
I had actually one suggestion, Avri. Hi.
Hi, Nadja.
Thanks very much for the paper. So I was wondering if it is possible to look at the executive compensation packages, because the literature showed that the compensation packages of executives might determine their risk taking, right? So if they have, for example, stock options and they would prefer perhaps high volatility, and this would influence your outcome variables. So perhaps a conditional analysis on the type of the executive compensation that the CEOs have might be interesting to look at. And I think there can be some really useful, insightful results there, if possible.
So yeah, so Nadja, we have a joint paper on these issues, so with Nadja. So yeah, it's certainly we could, I think executive compensation could be added as a control variable as well. We added institutional ownership, which was the Guillaume thing. It didn't really matter to the main results. I don't know if it would matter, but we could certainly look into that. I would like to also, go ahead.
Sorry, not as a control, but I might expect that, or one might expect that the executive stock options might influence the ambiguity and ultimately the firm decisions. So perhaps a channeling effect, so rather than a control variable.
Oh, so the stock options you're saying.
Yeah, exactly. So perhaps
You're
CEOs.
saying the executive is looking at their stock options instead of the firm.
Exactly. So CEOs with you know, a lot of stock options in their compensation packages might maybe opt for higher ambiguity and what this means for your outcome variable. So a channeling effect kind of for a conditional analysis.
Well, except the fact that the options that they would have, and let's say they have stock. I mean, I have to think about options, but as they have stock, it's the same ambiguity and risk that we are measuring in our,
Right.
so they're just aligned with the firm,
Mhm.
the way I see it at least, but we have to think about it.
Mhm.
So I'd also like to thank the discussant for a very good discussion. Really would like to see the slides and there are things we can do. The Atlanta Fed survey is something we should really look at to see if it could add to this. Endogeneity, so, you know, it's always there. Maybe we should use a more nuanced language. What we try to do, like you pointed out, you know, we have the time lag that we try to use, a lot of control variables and many fixed effects. So we try to do that. Perhaps we could look for an IV as well. And in terms of the news shift, maybe you'd want to weigh in on the question of the ambiguity measure and the shifts the news can create there. I think we had this question before, but you could weigh in on that.
Okay, thank you for your comment. I will try to just respond to this thing that you mentioned. First, about the assumption when we are measuring ambiguity, why we are using daily data. Daily, we divided the months into the number of days and create histogram for each day. Actually, it doesn't matter because we tried, even if you will take half a day or if you will take like in only one day and divide it, the day in compute ambiguity per day, the result will be more or less the same. Now, in this paper, we didn't do all the robustness tests, but in previous paper of mine, I did tons of robustness tests. If you change the bin size and if you're taking a frequency of not 5 minutes, but 20 minutes, or if you take 30 seconds instead of, all this has been done to show that typically the measure is robust to those settings. So it's not necessarily the setting, they are not required, it's really robust to other settings. Now about the news, the effect of news on ambiguity is an interesting question, how ambiguity responds to news. And I have a different paper that deals with this. And actually news reduce ambiguity, but increase risk. The fact that news increase risk is well known, but the fact that they decrease ambiguity is a new result. Now, another thing that you mentioned, what happens if we have a shift in the distributions? For this reason, we are controlling also for the volatility of the mean. And this actually will capture all the shift in the distribution that are not related to ambiguity. So we thought about this. Again, we wanted to make the paper as short as possible. This is why we didn't include all these different way to compute ambiguity and all these robustness tests that I've been showing in different papers.
But maybe we should add, because we also tried quarterly, maybe we should add some of these things, you know, like in a footnote or at the end to make sure that, you know, this is there. And again, Stephen, thank you very, very much, and send us the slides. We'll look into them. A great discussion.
Great. Well, thanks everyone for the presentation, the discussion, and of course participating. Before I let everyone go, two reminders. One, next week is our last of the year WEFI lecture series. Ayako Yasudo from UC Davis will be presenting a talk on private equity. It's called Creation or Extraction, the Role of PE. So check that out. The registration email will go out soon. And last but not least, we have a student-led workshop on entrepreneurial finance and innovation. And we have a couple of the students here. I'm going to let one of them, we have Chavi or Katya, I think, unmute themselves and give a quick 2-minute pitch for why any PhD students in the room should submit their papers.
Absolutely. Hey, thanks, Mike. We're accepting submissions of student papers for the student-led workshop on entrepreneurial finance and innovation. The deadline is 15 December. So faculty, please inform your students, fellow students, please send in your papers. We're looking forward to reading them and looking forward to all your submissions and to see you on the 1st of February. I'm also going to put in just the link on the chat for more information. Thank you so much.
Wonderful. Thanks. Well, thanks everyone for coming. Hopefully we'll see you all next week.